And to start with, I will tell you guys the hardest thing in finance is to say when. It's not that hard to say how or why, but it's almost impossible to say when. And that's my frustration, at least, is, when will these things start to materialize? When will these things happen? But we'll talk about that for a good bit today. And then also, whenever I start these webinars, and, I always like to reflect on why did we start doing these? The reason we started doing these was COVID in 2020, and exactly what Vince asked, which is, when are you going to have in-person events? How are y'all, going to get back to that? And it was frustrating not being able to do that. But I also realized at that point in time, and I think this is true because none of us go through life all by ourselves. A lot of you guys had the same concerns and the same questions. We're all dealing with the same economy. We're all dealing with the same market. We're all dealing with, a lot of the same issues. And so it was a nice way to address a good number of people. But one thing we started doing that I don't want to eliminate here is opening up with prayer. So let me do that, and then let's get going as far as the slides go. Okay, guys? If you're into prayer, please bow your heads and we'll do this together. If that's not something that you like, just ignore us for about 30 seconds, okay? All right, let's do that first. Lord, help this to be a good hour we spend together. Bless a lot of lives, most importantly, so we can bless others. But Lord, give us what we need so that we can take the money we have as a gift from you and do things in life that both give our family blessings and others blessings. Amen. All right, there we go. So let me go ahead and start sharing the screen, and then from there, we are going to talk a little bit about the investment landscape and what I said earlier about frustration. So, to start with, we have kind of a funner and more open platform today, where we're going to do some investment management and what we're thinking about the markets. I think that's always a good update. And then our advanced planning ideas it's really silly, but it's a lot of fun. We're going to talk about financially how to handle Thanksgiving and other holiday events with your family. When we get there, we'll give it some more context. And then finally, we'll have a conclusion. But to begin with, we are Merit Financial Advisors, and obviously most of you that work with us have either worked with LPL or Fidelity or some of our other custodians. So definitely have that here. I started with this because I think right now is a very important time for us to understand that there are different investment strategies available, and each of them has a different purpose. And one thing that I find very frustrating in this market is looking at just what's going on overall, but not necessarily how that should differentiate between our different styles. And I will tell you guys, if I go through these, each of these has a different function. One thing I love about these models is that when we put them together, whether it be from American funds, our core, which most of y'all are invested in, our Merit Select, which is a little bit more indexing, you are going to get a different feel and balance on the market. And the hardest part, notice what I said before, it's easy to say why and how. It's impossible to say when. I will tell you from all these strategies, the American funds, the Merit Core, or the Select, they all have their own season. And there are different times each of them do well, which is why we run these different portfolios and evaluate them based on not necessarily their performance versus one another, but their performance versus the market, and are they behaving and acting like they should. And then when we come down to this idea of satellite portfolios, I do want to stress this a little bit. These are the idea of, folks that come to us and say things like, I just want some NVIDIA stock, or I have this money over here and all I care about is not losing. Or, what I'm really trying to do here and look at this ESG equity over here is promote social causes I believe in. And you put that in, but it's not necessarily the core of a financial plan. But I'm letting y'all know these are out there because a lot of times when something doesn't look like it's optimal, it might not be that it's performing wrong. It might just be that it's the wrong thing for the wrong time. So a great example, when you look at this and you look at the core portfolios, it's kind of in the middle intentionally. This American funds idea is going to be much more of an active management. The select idea is going to be much more of a passive management. Both have their season. And what we're trying to do is blend those together in the core. Um, Not saying one is or isn't the best. It's just, it has its time. And this is an important time to think of that. And when we do your asset allocation, remember this slide and remember how I'm talking about this, because it decides a lot on where we put the money. And this is the key takeaway, not on what we think the market is going to do, but when you're spending it. And that is a totally different goal that is much more, time oriented and much more specific. Um, no, let's kind of talk about the big elephant that's been around, and this chart says a lot of what's happening here. Is simply, the Fed funds rate and the LIBOR rate, how much that has increased year to date and certainly part of last year. And if you look at this spike, I mean, it's pretty much unprecedented. You go back all the way to 1995, and obviously you can see what the Fed's funds rate was, but we're getting close to where it was around the early 2000s, where the tech bubble bursted, but we also had just an enormous amount of unpredictability with 9/11 happening as well. As you go up, what this means, if you really think about it and you look at these dates, is every year or two or three after these big rises, the stock market has done extremely well. It really has. And these will slow down the stock market, but they do not necessarily mean the future is going to be worse than the past. And if anything, this is also a time, and I remember back in, and we're talking right after the financial crisis, we got 12 to 13% a year on bonds for like 1 to 2 years. And that just hadn't happened since then, but that was because of rates going down. So what this has done, we have raised rates, and we're going to talk a little bit later when you look at some inflation statistics and some other stuff, but it's creating opportunity for the future as much as it's slowed things down now. And then economically, and we brought this in really because of what's happening in Israel right now. One thing that you will find is if you look at any of these events on the left, and I am happy to email you guys these slides, certainly don't think you're going to get it all now. But if you look at these events, most of them ended up with positive returns if you look 12 months out. A very small minority. And you can even look at some of these events, which might have been very negative from a geopolitical perspective. They're not that bad as far as the market goes. And so, you look at what's happening in Israel right now, and I hate to say this, but there's not that much economic activity happening in Israel and Gaza. There's some huge humanitarian problems, but let's separate those two in our mind. And that's the point of this slide. And you can see from these other areas, how that really has been separated in the past as well. Also, leading indicators. Back to what I was saying about inflation and rates going up and those two correlating, one thing you will find is whenever the leading economic indicators get negative for a little while, we tend to have a really nice expansion period following it. And that's where we're at right now. Who knows if this should have been a single dip recession or a double dip recession? I have my own personal theories about that. They mean nothing as far as value. But one thing I do think is very true right now is we're getting to a point of rationality and being able to predict the future that we had not been in really since 2020. If you think about COVID, what it really did was blow up our assumptions on what the world is supposed to be like. Now we're getting to a place where all of a sudden, we kind of went down, we went up, down, we're kind of settling out to about where it should be. So at least for me, this is positive that we're seeing this sort of decline and a little bit of slowdown that probably should have been there anyway if you looked at 2010 to 2020, and then certainly enhanced by COVID. Also, and this is very important, when the Fed raises rates, until you actually feel it in the economy, it really doesn't do anything to slow inflation. And what this slide is showing us is that They have raised rates, and it's now digging into people's spending ability. And that's good because that's where the economy will slow down and they can start lowering at some point. Also, we're seeing, and you'll see this in a minute on the inflation side, it's not only credit related this time around, it's a lot of supply chain and a lot of that is opening up. But, it's certainly harder to borrow money. I don't know if, a lot of you guys have paid for houses, but those that are going into the mortgage market right now, my gosh, borrowing at 8% is just a lot different than borrowing at 2%. And it's a different environment than it used to be. You, of course, will see some delinquencies on people that probably shouldn't have borrowed the money to begin with, but that's not necessarily a negative. That might actually be a positive. You kind of have to, almost clean house in a sense. Also, on these inflation measures, if you look at it, peak to trough and current, we've gone down on every number imaginable. I mean, it's just amazing the year over year. Very predictable, but it's nice to see. And one thing we will realize is you may or may not feel it as much as you hoped you would. But if you look at what's happening in the headline inflation, we're now one of the lowest countries in the world. Um, that's pretty important. And if you look at the people that have higher inflation than us, you can really start to see a message of, why their supply chains maybe not as good as ours versus the way we're established. And you got to remember that a lot of this stuff doesn't necessarily feel that way because if you look at inflation from 2010 to 2020, it was basically zero. And then you look at it from 2020 to now, and it's been significant, but a lot of that has not been in the last year. A lot of it was in 2022. You can also find with that, we now have a new kind of economic thesis that I'm going to go through for equities. Later, we'll come back to it for fixed income. But if you look at this, all right, monetary policy remains pretty tight, and that'll happen into 2024. So what do? You got to diversify through that environment before you eventually find some leadership in the market. Also, a soft landing economically is probably unlikely and recession risk remained elevated. But guess what? A lot of times equity markets go down before a recession and they go up even during a recession or, towards the end of a recession. So that is an area you need to separate the two. And then recent market volatility has certainly increased, and that has created significant dispersion in relative valuations. So we'll talk about that a little bit more, but what that really means is, yes, the volatility has been there, but a lot of both the gains and the volatility you're seeing have been centralized around a few stocks, which creates a lot of opportunity probably in some stocks that haven't moved that much. And then, of course, geopolitical risk remain elevated. But here's the thing about geopolitical risk. When I look at all of this, you look at monetary policy. That is something we can change investments based on. You look at the soft landing. That is something we need to coach you guys not to pay attention to. Same with recent market volatility. Geopolitical risks, it basically mitigates itself based on time. And so think about that when we take your portfolio back to your financial plan. We give your stocks long enough, hopefully Ukraine and Israel are not an issue. In 8 years, if we're still fighting in either of those places, I'm not saying that's impossible, but I'd be surprised. And I'd also be surprised if we haven't made a ton of money doing other things somewhere else. But short term, they can be. And that's why we wanted to make sure that we spent some time on this slide and what we're thinking about it. The main thing I want to focus on with you all is knowing what we feel is the noise and knowing what we feel is the valuable information and helping you discern the difference. All right, so a couple other things on equities here. You look at median drawdown and earnings during a bear market, and we've already kind of been there at the recession level and the non-recession level. But at the same time, what we're starting to see is actually pretty good earnings, not negative earnings. And then also, if you look at this, and this is an incredibly important chart when you think of the thesis and the economics that I showed you before. This is the dispersion on 1 year versus 10 years in the market. And as you'll see, it is a very predictable 10-year return over time. It's not always the same thing, but it's not as random as 1 year is. 1 year can be all over the board. And so what I'm getting at with this type of slide is really don't look at necessarily 1 or 2 years with a pattern bias or other things that can come in from behavioral struggles.
What's going
Look
on?
at it instead with a little bit longer. Yes, go ahead, Juliana.
He's still sending up get well stuff to people. Okay.
Hey, Juliana, are you on?
Thank you. Email.
You need to mute Juliana.
Sorry, it was me. My apologies.
That's okay. Do we have a question? And by the way, if you do have a question, please submit it in chat and Juliana will read it. But was it a question or somebody coming into your office?
It was Jim coming into my office. I am so sorry.
That's all right. No problem. Tell Jim to come over and smile on camera and apologize. No, I'm just joking. So where I'm going with this, if you look at this dispersion, what you'll find is creating a financial plan actually is very predictable and makes a lot of sense over a long period of time. Any 1 year, it can be all over the board. So don't go ahead and anchor on what you might have experienced in a 1 or 2 year time frame. This chart does about as good a job of saying that as anything I've ever seen. So a little more on, well, all right. Oh, this is fixed income thesis. Okay, and it says equity thesis up there. Sorry, we don't always put these together perfectly, but as we jump from what I showed you here, which is valuations of the 10-year periods versus 1 year period, that's with stocks. So let's go into valuations on bonds, and that is actually much, much, much more random. You might not think so because it's a little more tight, but it's a lot more random. So like, for example, the difference between bonds earning 2 and 4% a year is pretty darn significant. That'd be like equities earning 10 versus 20%. And so if I talk about equities, maybe they earn 10, maybe they earn 8, maybe they earn 12 over the next 10 years. It's actually a pretty small variance. When you look at fixed income, man, they could be all over the board, and a lot of it has to do with interest rates and the forward aspect on that. So if you look at the fixed income thesis, I actually think it's going to be probably better over the next 10 years than it was over the last 10 years. Have very little reason to think I can say that about stocks. So with fixed income, tight monetary policy actually helps. Because going into 2024, what we can look at now is the ability to get a higher interest rate and yield than we have had over the previous decade. So one thing we're able to do, and I'll show you this in a minute, is shorten duration, meaning the lengthier bonds, but still get the yield. We'll talk about that when we look at the inverted yield curve. And then also slowing growth is actually a really nice feature for bonds, tends to be a bad feature for stocks. And what happens with slowing growth is it does move towards, you have two risks in bonds always. It's credit risk and interest rate risk. With slowing growth, what happens is as long as you're in good credit, and this is what we mean by the investment implications over here towards higher bonds, which you can now get, it's kind of beneficial because if rates go down to stimulate the economy, you make capital gains on your bonds. So overall, I would say my outlook on equities is a little bit kind of just average. Fixed income, I think it's better than average. And when you look at bond market volatility, one thing you'll find if you watch it over time, certainly the spike in 08 at the beginning of this chart shows you a lot, and then some of the spikes later, but especially if you look at this from 08, what you find is after you have this volatility spike, you usually get really good returns in the next year or two. Again, I'm telling you the how, I'm telling you the why, I cannot tell you the when. And then here's that yield curve I was talking about and why we do believe you can make a little bit of money by shortening up that duration. This is an inverted yield curve, which in the past has taught us or told us, I don't know if you can ever say that the yield curve teaches you something, but it has told us that the market's going to go down and we're probably entering a recession. This time around, I actually think, and if you go back, any of y'all that have studied finance or anything like that in school, they've always taught you not to pay attention to the yield curve as a predictor to stocks. But the correlation has been there. And I'm not sure that I would normally want to heed that advice. What I found here, and what I'm even seeing in the way the market's performing, is that's probably true. And if you look at it, what it's maybe telling you more about now is inflation expectations, not necessarily economic expectations. And we're now in a situation where the lower inflation goes, the better that'll be. So I think that that's what the market is predicting by the line you see here. And just to learn how to read this green line is what you earn by investing money in treasuries for that time frame. And so what you'll see is you're getting paid pretty well if it's a short-term treasury. You go out here to a 20-year or 30-year treasury, and it's not that high. So what this will say, if we're actually looking at how to invest in the yield or in the bond markets, we probably want to own a lot of short-term. And we probably want to own some long-term, but we really don't want to own much midterm. And that's it. That's what it's telling us. Any questions on that? Just know we're paying attention to this, and this is how we are moving your portfolio around. Also, as the yield curve steepens, one of the things that we definitely look at is, what are the recession risks and with that going on, but that is a different number. But it's certainly a number that does impact the future. And one other thing I would say, and this is a very optimistic chart if you think of actively managed fixed income. When you look at this, we have the spread on the bottom. The line you're seeing here is the treasury market. On the top, the line you're seeing here is the high yield market. And you always look at the spread there. So when you go back to a year like 2020, for example, they were moving together. So there's no reason at all for us to take any credit risk. Now you're seeing a big spread, which is, okay, I can go invest in an average treasury or, a portfolio of that and maybe earn 4.5 to 5. Great. I can go out and invest in high yield, which is really corporate debt. So, so many of y'all have worked for AT&T. Let's think about AT&T this way. I don't doubt their ability to pay off their bonds, but I'm not all that excited about their stock. But they make enough money they can pay their bonds. So if I can go out and buy an AT&T bond or some other corporate bond that's yielding 8, 9, 10% versus a treasury yielding 4, 5%, that looks pretty appealing. And when those yields are the same, it's not worth taking that credit risk. But when they're not the same and you actually see a good spread, it creates opportunity. And that's what we're trying to do with some of the bond positioning and mutual funds you guys will see. Also, you have to realize this. Because rates have been low and they're about to, need some refinancing. So what I mean by that is, let's say a company issued a 3-year bond or a 5-year bond or even a 10-year bond in the past. Once that is due, they either have to, pay off the bondholders and lower the amount of debt on their balance sheet or refinance at a higher rate. And if they do that, that is a concern, but it's not necessarily a concern right now. What we're saying is maybe down the road. And so much of that has to do with, let's look at a year like 2025 or 2026, where that becomes significant. It has a lot to do with what are those companies' earnings at that time and not necessarily to do with how does this chart look right now. But it is important to realize that it will happen. And hopefully, if rates go down, this chart is irrelevant. But if they stay where they're at right now, this is about where it's going to go. And we look at that refinancing, that could be a headwind. But we're not ready or willing to go ahead and make an assessment on what that'll be. I mean, certainly, if any of y'all have looked at the past 3 years, you can say it's pretty hard to predict what's going to happen in 2025. If any of y'all have that type of crystal ball, please let me know, and we'll hire you instead of charging you a fee. And then also this large yield increase in corporate debt, basically, it goes right in line with what I was saying, which is we now have that same yield curve, but a little bit more options as far as where we want to place that. So no, everything I showed you with the treasury yield curve also participates in the corporate yield curve. And so with this, back to the original slide and kind of starting from where we began, each of these, if you look at this, and we're happy to see this slide, this now says what we're doing and the objectives. So if you put all this, the macro I just showed y'all is true for every single one of these objectives. The way we actually put it into practice is different for each of these objectives. So the question becomes not necessarily what's happening in the economy, but what's right for you. And because of that, this is where your advisors will blend some of these styles and put these together. But definitely want y'all to know these are out there. And certainly, let's say, for example, I have a client in core equity and they're upset the market went down too much over the last month. I'm not giving a specific example. I'm just talking in generality. One answer could be, all right, core equity did what it's supposed to do, but if we knew the market was going down, we could have invested in low volatility. And most of the time, that will solve the issue, but every now and then, we have what we call systemic risk where everything gets hit. COVID was a great example of that. All these got impacted by COVID, but I don't think that's going to happen necessarily. And part of when I talked about the rationality of where the market's at is all of a sudden all these are functioning different, which shows me that we're in a more normal economy. All right, so I will pause from there and we'll go into the next slide in a second. Any thoughts and questions? Because otherwise I'm going to jump into just having some fun together.
There was a question that came in earlier, and percent of portfolio and fixes, tip or non-tip treasuries. Oh, fixed.
Say that again. You kind of cut in and out for me, maybe not for everybody else. I'm not sure whose internet that was.
It said percent of portfolio in fixed tips or non-tip treasuries.
Yeah. So great question. Don't know who submitted that, but depending on their economic knowledge, we can talk about tips in a very different way. Let's assume efficient market thesis, and I will answer it from there first, which means basically the market is very smart and is a better judge of the future than any one individual. In that scenario, they're the same thing. So the question doesn't matter. The reason you would buy tips is if the market is not efficient and therefore it has underestimated future inflation. And in that situation, the tips can add a lot more value over inflation or over a regular treasury. My concern with tips right now is I think most of y'all are burned on inflation, and I think most people are borderline angry at inflation, quite frankly. And because of that, I think they overvalue the cost of inflation insurance, right? This is, you live in Florida, what do you pay for your insurance right after a hurricane versus what do you pay for your insurance if they haven't had a hurricane? Because of that, I would go more towards regular treasuries versus tips. In fact, on a normal basis, when you're in a normal market, tips should have a lower yield. Like let's say you buy a 10-year tip versus a 10-year treasury. You should have a lower yield that will increase if inflation increases, but it won't otherwise. So that's why I would say I usually never even consider tips, but there's not necessarily a time that they're good or bad. But they should be the same thing.
Another question came in. Oh, are the CDs best use of gift and money in this market?
All right, I'm going to have to ask like 3 questions back to that. And by the way, I do like the idea of question and response versus question and answer. I think a lot of this stuff, it's, there is no answer, but there are a lot of responses, right? So for that, I would say, is the gift being given to you? Is it being given to someone else? What do they want to do with the money? I mean, CDs right now are more appealing than they've been in the last 13 years. Let's say it that way. There was a time when it was kind of like, why would anyone ever use a CD? We're not in that environment at all. In fact, they have a place and they're pretty good place, versus, and I have a lot of clients that'll say this, it's a roundabout number. I have $100,000 sitting in cash. Well, why do you have 100,000? That sounds a lot, and maybe you should invest part of that. Well, I just feel good when I have $100,000 in cash. I have no problem with that person saying I had $50,000 in cash and $50,000 in a CD. But I also don't think if you're going to leave the money invested for a little while, CDs are going to do better than stocks or bonds. And I think that's always true. The question is, again, not how does that happen, but when does that happen? And if you really think about it, it's a pretty negative and bad world if stocks or bonds can't outperform CDs, because now what you're going from is a risk-free asset and then saying the risk-free asset's going to earn more than the risk asset. That just does not work in a capitalistic society. Like that's not how it works. So I would assume other things can do better with the CD, but a lot of it comes down to placement in the portfolio and time horizon. What else you got?
I think those are all the questions for now. Now for the fun part.
All right, let's jump into this. So let's see. I think I'm still sharing, correct, Juliana?
Yes.
Sorry that showed y'all everybody's camera. All right. So advanced planning. So when you think about y'all's money, let's think about it in three pieces. We really have three big overarching ways we can help people. One, just investment management, and it's sexy, it's fun, it's what everybody likes to talk about. So we put that on the front end of the presentation. Second, advanced planning, which is really things outside of your investments that also help you financially. And then the third is just relationship management, which really means you as a person, your behavioral biases, working with your professional network, those type of things. So with advanced planning, and we both thought this would be fun. I will acknowledge and bring this up later, but ChatGPT helped us a little bit with this section. And I encourage all of y'all to look into that and try to do that, where appropriate. I was going to bring that up and show us some stuff, but we'll see how that works, because it looks like with sharing that might be a little harder than I thought. But here, let's go through it. So when you think about Thanksgiving, a couple of things come to mind for me. I mean, first of all, we're going to talk about, actually throwing a Thanksgiving. My wife and I are hosting for the first time this year. And one thing I can tell you is there's no real good way to do this financially. It's going to cost money, but at the same time, it's always fun to plan and think. So when you think about your feast, and let's talk about, just shopping in general. And I think some of this wisdom actually plays more into Christmas than it does Thanksgiving. If you're like me, my struggle in life is this impulsive buying. I'll go to the store with a shopping list and end up coming home with a whole bunch of decorations to make my table look like the one over on the right there. And then my wife will go, yeah, but did we really need these napkins? One thing I would encourage, and let's just talk about this in general when we talk about your finances, anything year to date or for the rest of the year, there are certain things that need to happen by December 31st. And as the holidays come, that's a really good time to reflect on this. And, before we overspend, I would say that it's a great time to think about giving. When you think about what to be thankful for, hopefully other people are thankful for the financial blessings you've received. It's also a great time to think about family and coaching them and being around them and, how to build those relationships with the people that will eventually be getting your money. Also, Thanksgiving treasure hunt. And this is where I want to show you all some ChatGPT if I can come up with it. So set a budget for stress-free holidays, hunt for deals and discounts, stick to your budget like a treasure hunt. All right, so I'm going to do a quick poll. Please put it in the chat, and Juliana, you can let us know if anybody says this. But if any of you guys ever use ChatGPT or been frustrated about what your family's going to do on Thanksgiving when y'all are sitting around the table, anybody?
I've used it for other initiatives, but not Thanksgiving just yet.
Who's that?
That's me, Juliana.
All right, well,
But
I can tell you why you should use it for Thanksgiving in a second.
we have somebody typing. Oh, this person has says I've used ChatGPT, but not Christmas and Thanksgiving.
Okay. All right, so let's bring this over here, and I want to show you guys a little bit of a treasure hunt here. And part of why I'm showing you all this is we have to realize where the future's going, where our value is, and then is there an investable idea or not an investable idea there, as well as can it help you plan. So what I would encourage y'all, depending on what you have going on for Thanksgiving, is you might be surprised how this can actually help you. So I have, for example, an 8 and a 9-year-old that, love things like scavenger hunts. They love things, prizes, things like that. So I'm going to use this at Thanksgiving. So let me show you guys a quick example here, and then we'll all talk later on about how to use this either to promote your own business or even connect better with your grandkids. So, and I really think this can help you connect better with your grandkids once you see how this works. And I know that's what well, not all of you guys, some of y'all don't have grandkids, but a lot of us want over Thanksgiving. So I'm going to say create a treasure hunt, scavenger hunt. Actually, I'm going to change this, a Thanksgiving All right, so basically this is what I'm going to try to do on Thanksgiving to give us some type of activity. I'm going to have a scavenger hunt for a 8-year-old boy and a 6-year-old girl. All right, there you go. Right? Questions. Again, right? Questions for an 8-year-old Braves fan. Obviously, my son's a Braves fan. To use in a scavenger hunt, ideally make it 10 questions. All right, so I want to have 10 questions and then give out a prize. All right, there you go.
Dave, do you mind zooming in just a little bit so I think people can see it? It's a little small.
Yeah, no, that's fine. Thank you.
Oh, never mind, I guess. Oh, yeah, there you go.
Is that big enough?
Yes.
Okay. I mean, look at this. So my point here is previously, this would be something I want to do and is a personal goal for how I host Thanksgiving. It would take hours personally. Some of y'all might know this stuff off the top of your head to create this list of 10 questions. But now that I did it, it can be a lot of fun and neat family activities. So I'm just telling you guys, don't underestimate the power of this stuff, because if you think about it, we've been using Google for years, and Google gives us information. What this now does is sort information, and use every resource you have. I can definitely go more into depth if any of y'all need lessons. We'll even host one on how to use ChatGPT for whatever reason. It's some powerful stuff. It's powerful. And we can even teach you guys to use the closed version, which is, it puts together the content the way you're looking at it, but what you're doing is limiting the information they can have. So, for example, when I asked that Braves question, all they did was go out and search Google and then come up with it. I could upload, let's say, a PDF of the history of the Atlanta Braves, and it could come up with questions that way, and that might be better. But at the same time, it's not going to go to anything that Google actually says, which, for better or worse, fake news, sometimes you want to edit it out. All right. So anyway, Thanksgiving treasure hunt, set a budget, work for it, stick to your budget like a treasure hunt. And, this is both holidays. I can't tell you, and don't do this. Let's just go ahead and say this. I can't tell you how many of you guys in January call up because y'all spent about $3,000 more than you wanted to on Christmas presents. Think about it ahead of time. And now's when you can. There you go. That's my public service message. All right, and then of course, gratitude and leftovers. I hope you all have fun. If I could create a bigger table, I would, and have each of y'all over. Can't do that. Sorry, my house isn't big enough. But hope you guys, really do have a great time with family. And certainly, we view you as family and want to share things on that level with you as well. So with that, I will pause for questions and response. If you need a meeting with me or one of our other advisors, please scan the QR code. Juliana will help that and facilitate that. And beyond that, I just hope you'll have a blessed rest of the year. Certainly, we love doing these presentations. Going to try to keep it at about once a month going into next year. But let us know topics. Let us know questions. Let us know things you'd like us to cover. And quite frankly, thanks for viewing me. If once a month is the wrong cadence and y'all need less or more, let us know that too. So I will pause and just see if there's any feedback from these brilliant, beautiful folks out there in Maryland.
I don't
see a
know
lot
if
of
you
hands clapping. Oh,
had
go ahead.
heard about it, but AT&T has their own chatbot. It's Ask AT&T. And what happens with the Chat GPT is if you upload code, like it can write code and different things for you. So if you upload it there, then it's not, it's public. Everybody can get your code.
Correct.
So AT&T created one, and I'm not sure if the Ask AT&T is along created with the Chat GPT people, or who helped create it. I'm not exactly sure, but
yeah. Or go ahead. Sorry, Rebecca.
It does the same thing. Like you can even put what you did in there. If you put it in ours, it'll give you maybe a little bit different, but pretty much the same thing. Yeah.
Yes. So what y'all have done with Ask AT&T and what you're talking about is exactly what I was talking about, where you upload basically your help documents or whatever other documents you want it to refer to, and then it only goes there. And the reason you would do something like that, if you think about a company like AT&T, if you go out to the internet or Google, who knows what the heck people are saying about AT&T and how that could bring it in. It could be that somebody made a nasty post talking about how they're angry about their cell phone bill last month, and then ChatGPT pulls that in, whereas obviously on AT&T chat, y'all would prefer it to say things about like how to help you on your cell phone, but not necessarily about all the bad things people say out there. So yeah, they did exactly what we're talking about. And if you think about it, it is that brain that they're using, but what they've done is limit the data. And there's actually a lot of value to that, depending on what you want it to do. So I'll give you a great example, Rebecca. Let's say I'm taking my family to Disney World, and I'm just making this up. Instead of going to ChatGPT, I could build one of these bots, and I could say, all right, here's our itinerary. Here's also, the information from the website on all the different options they have. And then I could write in there, write me a 2-day itinerary on how to maximize my experience at Disney World and Epcot with my kids. It would do that, but by not going out to the web, it would only deal with the information I have in there. So that's where it could be valuable. For example, let's say I'm in y'all's shoes and I want to take my grandkids to the Magic Kingdom and Epcot, but not necessarily, Hollywood Studios. That's where limiting the information comes in.
From my experience, I've been using ChatGPT as Google or Yahoo or any search engine. Would you search like, okay, I need David Elder. Here's David Elder's address and his social security number. Will you please create a document that has like some information? Would you probably type that in Google? Probably not. So that's how I've been using it is whatever I do, I kind of have the same mindset as if I'm looking for information on Google. And that's really
Yeah.
helped me so that I protect my information, my friend's information. If I'm sending something for a client, I'll say this is a client who likes to row. Please write a message for her in 3 sentences. I wouldn't say Debbie likes to row. Debbie Gifford from Alpharetta, Georgia, or Georgia likes to row, and she lives in this neighborhood. Please write a message because that means that the information will be out there, similar to if I did in Google. So
Right. Well, and I love that. I think you're right. It's a better search engine than Google. The way I've always differentiated, and tell me, Juliana, how you might even add on to this. You're so smart in these areas. Um, it's more about organizing the information, not just finding the information. Like Google can find the information for you. The problem is you then have to organize it.
yeah,
You know?
that is true.
Yeah, and so, if you notice what I asked, it was write an itinerary. It wasn't give me ideas.